Hello and welcome to our lesson 4. In the previous lesson, we looked at long-term sources of finance. In this lesson, we will look at financial markets and financial intermediaries. Financial markets are platforms or systems where individuals, businesses, and governments buy and sell financial assets, such as stocks, bonds, currencies, and derivatives. While financial intermediaries are institutions that act as middlemen between savers and borrowers, helping to facilitate the flow of funds within an economy. For example, banks, investment funds, insurance companies, pension funds, and many other. Financial markets are categorized based on two key dimensions. 1. Primary markets versus secondary markets. 2. Money markets versus capital markets. Primary markets are markets in which users' firms raise funds through new issues of financial instruments such as stocks and bond. Most such issues are arranged through investment banks, who serve as intermediaries between funds, suppliers, and users. Such intermediation is usually in the form of underwriting, guaranteeing the issuing firm of a fixed price by buying the whole or part of the lot and selling it to investors at a higher price. Primary markets financial instruments include equity issues by firms to be traded by the public for the first time, IPOs or initial public offers. Secondary markets. Once financial instruments such as stocks are issued in the primary markets, they are often traded in the secondary market. New investors buy from original investors. Examples include NYSE, Amex, NASDAQ, ESDAQ, LSE, NSE, JSE, and Extra. Buyers of secondary market securities are economic agents, consumers, businesses, and governments, with excess funds, and sellers are economic agents with need for fund. 2. Money markets versus capital markets. Money markets trade in debt securities with maturities of 1 year or less. The short-term nature of this nutriment means that fluctuations in their prices in the secondary market is quite minimal. They are usually traded as over-the-counter, OTC. These markets have no specific location. Rather, transactions occur via phone lines, wire transfers, and computer trading. FIs and depository institutions, e.g. commercial banks, are required by central banks to maintain cash reserves. As such, excess is traded in these markets. Money market instruments examples: commercial paper, treasury bills, negotiable certificates of deposits, and more. Capital markets trade in equity, stocks, and debt, bond, instruments with maturities in excess of 1 year. Given their longer maturities, these instruments experience wide price fluctuations in the secondary market than do money market instruments. Examples of capital market instruments are corporate stocks, residential mortgages, commercial mortgages, corporate bonds, federal and local government bonds, bank and consumer loans, and many other. Financial assets are intangible assets that derive their value from a contractual claim or ownership of financial instruments such as stocks, bonds, bank deposits, and cash. These assets do not have a physical form like real estate or commodities, but hold monetary value and can be traded in financial markets. Examples of financial assets include cash and cash equivalents, e.g., bank balances, treasury bills, stocks, equities, ownership in a company, bonds, fixed income securities, debt instruments issued by governments or corporations, mutual funds and ETFs, pooled investments in stocks, bonds, or other assets, derivatives, contracts like options and futures. Features of financial assets. Here we will only look at characteristics of the first 4 outlined features. 1. Moneyness. Money is used as a medium of exchange or for settlement of transactions. Assets that can be transformed into money at little cost, delay, or risk, for example, time and savings deposits and government securities, are referred to as near money. This property is the moneyness of the asset. It is a desirable property for investors. 2. Divisibility and denomination. This refers the minimum size in which a financial asset can be liquidated and exchanged for money. The smaller the size, the more the financial asset is divisible. A deposit may be divisible to the last cent, but other financial assets have varying degrees of divisibility depending on their denominations, the dollar BER value that the assets will pay at maturity. In the US, bonds come in $1,000 denominations, while commercial paper comes in $25,000 denominations. Divisibility is desirable for investors, but not borrowers. Third, reversibility. This refers to the cost of investing in a financial asset, then getting out of it into cash again. It is commonly referred to as the turnaround cost or round-trip cost. This cost comes in the form of commissions for market makers, bid-ask spread, and the time and cost of delivery of the asset, if any. The bid-ask spread is mainly determined by the thickness or thinness, frequency of the transactions of the market. A low turnaround cost is clearly desirable property of a financial asset. 4. Cash flow. The return on an investment depends upon the cash distributions, for example, dividends and expected selling price on shares, and the principal and coupons on bonds that the asset will pay. Non-cash payments, for example, bonus shares and options, and inflation are also accounted for. When inflation is factored in, we have the real rate of return. Otherwise, we have the nominal rate of return if the effect of inflation is unaccounted for. Role of financial system in the economy. A financial system is composed of financial institutions and financial markets. When you talk of the financial system's role in an economy, you are indirectly addressing the role that financial institutions and financial markets play in an economy. The roles include: 1. Transmission of monetary policy. Because deposits are a significant component of the money supply, which in turn impacts on the rate of inflation, depository institutions, particularly commercial banks, play a key role in the transmission of monetary policy from the central bank. This may be through variation of the reserve ratio in order to increase or lower money supply. 2. Credit allocation. A financial system offers the economy with a unique service as a major conduit of credit to sectors of the economy that need special financing, such as farming and real estate, residential specifically. Authorities in such cases may require that a significant portion of FI's assets be in the areas identified. 3. Time intermediation, intergenerational wealth transfer. Most countries offer relief and subsidies to encourage investments by savers in life insurance and pension funds to enable the older generation to transfer wealth to the younger one for payment services. Depository institutions and thrifts are special in that the efficiency in which they provide payment services directly benefits the economy. Any breakdown in the payment systems, check clearing of wire transfers, would result in harmful effects to the economy. Definition of a stock market. It is a market where securities are bought and sold. Securities refer to shares, debentures, treasury bonds, treasury bills, etc. Stock refers to capital detained by a company through the issue of shares. Bonds are debt instruments used to borrow money from the public. Members of the stock exchange. 1. Stock jobbers. These are members who buy and sell securities in their own names. They sell securities at a profit called a turn. They buy shares in wholesale and hold them for speculative purposes. 2. Stockbrokers. These are middlemen between the investing public and the stock exchange. They are agents who earn a commission from the buyers and sellers. Members of the stock exchange must pass through them for technical advice. Functions of stock of exchange. 1. Provides a ready market for stock, shares, bonds, debentures, etc. 2. Facilitates the flow of new capital into the industry. 3. Facilitates savings, encourages savings by individuals. 4. Protects investors by reasons of the rules of the stock exchange. 5. Companies seeking capital are advised and guided by all stages. 6. Shows the trend of business in the stock exchange, provides an important barometer for business throughout the country. 7. Investors are able to obtain capital from the public. 8. It enhances the inflow of foreign capital. 9. The title to any quoted security is transferred speedily and cheaply. 10. Disciplines the company's management by ensuring that the companies fulfill certain requirements and follow certain rules before securities are listed in the stock exchange. Quotations in stock of exchange. Quotation is consent by the stock exchange for companies' securities to be dealt with in the stock market, that is, to be bought and sold in the stock market. Requirements of quotation A. A company must be a public limited company. B. It must be registered with the Registrar of Companies and must submit a certification of registration. C. The company must provide details of the current directors, company lawyers, company secretary, company auditors, financial year-end and subsidiaries, branches of the company. D. Such a company must inform the stock exchange the current distribution of the shares. E. Such a company must be willing to offer the public a minimum number of shares. F. Such a company must pay a clearing fee. G. Such a company must issue a prospectus to the stock exchange. H. Such a company must issue a statement of dividends and bonds issued in the previous 5 years. Advantages of quotations. 1. A quoted company is able to raise finances quickly and easily. 2. A quoted company is considered to be financially stable. 3. A quoted company can easily obtain a loan. 4th, a quoted company can compare itself with other companies. 5. There is prestige associated with quoted companies. 6. Quoted companies are forced to operate within certain guidelines. Disadvantages of quotation. 1. Loss of secrecy means the company loses its secrecy through the publication of the company's shares. The secrecy is also lost by inspection of the books of accounts by the shareholders or by the public. 2. In case the company's profits decline, this will be revealed to the public and will lower the share prices of such a company. 3. There is loss of control to incoming shareholders. 4. It is expensive because of the fee payable to the stock market. 5. The formalities of quotation are tedious and tiresome. 6. Immediately after quotation, the prices are likely to be low. 7. A quoted company can easily be taken over by people buying shares in the stock exchange. We have come to the end of our lesson. Thank you for watching, and let's meet in our next lesson. For more notes and clarification, visit techneragency.site